right, so we're here today to talk about the new stacking returns paper. Before we get going, let's talk about what motivated you guys to think about this theme and why would we write this paper. For those listening, this is primarily the brainchild of Rodrigo and Corey. So Mike and I are going to kind of moderate a discussion and put Rodrigo and Corey on the spot for a change. So which one of you wants to go first? Like, why did you guys write this paper? What's it for? Who's it for? What problem are you solving?
Yeah, Corey, why don't you start with the kind of the valuation, expensive markets and all that?
Yeah, we can start there. So I think just about every major investment firm out there has been forecasting low real returns for a traditional 60-40 portfolio for the better part of at least half a decade. Most major firms since 2015, under the expectation that there's going to be strong reversion in equity valuations, which are historically high right now, and that when you look at fixed income, the gravity's a little stronger, that your starting yield to worst is a pretty strong predictor of your forward nominal return. So you subtract out inflation, even if you sort of discount inflation below what a lot of people think it'll be, you're still talking about real returns for a 60-40 portfolio that are depressed on a historical basis. You sort of contrast that to the experience everyone has had with the 60-40 over the last decade, particularly American investors who we deal with predominantly, who have that home country bias and invest in the S&P. And it has been, over the last decade, one of the highest realized risk-adjusted returns for the 60-40 portfolio ever, going back at least 100 years.
Especially on a risk-adjusted basis, yeah.
Yep. So you have this unbelievable total return, unbelievable risk-adjusted return, and you contrast that with the expectation that going forward returns are going to be quite poor. And so we have this struggle, which is everyone is anchored to the wonderful performance of a 60-40, and it is becoming more and more difficult to have conversations with advisors and investors and move them off of that base, while recognizing that staying with that base is driving while looking in the rearview mirror. And so there have been a number of products that have come to market now that are enabling us to do new and interesting things with the portfolio. And I'll let Rodrigo go into that a little bit more. But the question was, how can we sort of bridge the gap, which is people aren't moving off the 60-40, but we need to find ways to introduce new sources of return and new sources of diversification, particularly potentially towards things like inflation, without making them very uncomfortable the way that introducing liquid alternatives over the last decade did. And so that's where a lot of this return stacking idea came from. Last thing I'll say is I need to give credit where credit is due. Rodrigo came up with the phrase return stacking. I think it's brilliant in how easily it explains what we're trying to achieve, both on the pros and the potential risks side. So all credit to him for the paper title and the concept.
Well, yeah, thanks, Corey. I think the one thing that really drove me to try to find a better solution is the fact that when you compare how people perceive the expensiveness of a bond versus equity, they can see a low yield in bonds. And what has happened it's caused investors and advisors to move up the risk scale, right? Move up to more equities, or equities that are bond-like, or bonds that are actually high-yielding, high-risk assets that ultimately you can see a line item that you might say it's 40% bonds, but when you dig into it, it's really just a different way of getting exposure to equities. And the portfolios have gotten highly pro-cyclical, meaning that whatever offset you might have gotten in a bear market or an abrupt negative market shock from bonds, it's no longer going to be there, right? So you see more and more of these advisors seeing the low yield in bonds, adding to equities to reach for yield, get a higher return, without them realizing that it's really putting their clients' futures at risk. So that was, to me, I saw that and said, there's got to be something we can do to add diversification and improve that, help them keep their 40% bonds and stack different types of diversified returns on top.